See, what you have to ask yourself is, what kind of person are you? Are you the kind that sees signs, sees miracles? Or do you believe that people just get lucky? Or look at the question this way. Is it possible that there are no coincidences?
What is going on YouTube? It's Brendan from Market Makers. I hope everybody had a fantastic weekend, a holiday weekend for many of us that do celebrate. Hope you enjoyed that, guys. We had the CPI come out today. We have our pivot date this Friday. We have the market pattern matching.com to the candle. We have a lot to talk about, targets that were hit, trade updates, lots to go over, guys. So take a moment, smash the like button, hit the subscribe button. Love having you guys here. And guys, if you want to come trade with us and check out our room, our Discord, our Market Makers Discord for our professional staff there, all you have to do is try out one of our two sponsors. Try out SimpleFX, a decentralized Forex exchange where you can trade all the individual equities, the indices, the cryptos, as well as commodities and Forex. All with our link, you get up to a $5,000 instant deposit bonus. The details, how to join, all that is pinned in the comments as well as the video description. And you can check out BingX if you want a traditional crypto exchange to be able to trade dozens of different altcoins. Both of them are fantastic sponsors. And guys, they'll pay for you to join our room. So check out one of those apps, message Lee in the Telegram. That's pinned there as well. You can message Lee and he'll get you set up to join our Discord for free. All right, guys. So reading the comments as I always do, outside of the one or two morons that post in the comments. Man, there's people take trading so personally. It's hilarious. But you guys have a lot of good questions, a lot of good points, and I appreciate the love in the comments as well. But a lot of people are asking me, why don't I talk more about the DXY or some other influences in the market? At this juncture where we are in the marketplace, guys, the strongest influence in the cycle, as you guys know, I believe we are trading in our 7-year cycle, our bubble cycle. Those of you that know, tracking to the .com pattern, as I've been beating you to death with this over a month now. So in this cycle, the strongest influence right now is not inflation, which is why you had the CPI drop a whole percentage point from 6 to 5. Core inflation went up, I think, 0.1%, but in the market had a muted reaction, right? And a lot of people in the Discord were asking me too, how come the market barely pumped up? It barely pumped up. It didn't do a big spike up. And that is because where we are in the cycle, earnings are much more important. As you guys know, this Friday, our pivot date, JP Morgan, the world's largest investment bank, is reporting earnings, as well as Wells Fargo, as well as PNC, and some other big institutions as well, guys. So this is key. It's not so much how much money JP Morgan made. It's what their guidance is going to be for the year. With credit tightening due to the bank failures that we've had, with the Fed most likely still raising interest rates, according to Fed futures, still a better than 60% probability they're raising another 25 basis points. And based on the interviews I've seen with the different Fed heads, it sounds like they're going to be raising interest rates. Everybody wants to know, how will this affect earnings? Earnings were revised down last quarter. So this quarter, if earnings come in at these revised levels, remember, this is an earnings recession. So even when you hear them say on the news going into this cycle of earnings, oh, well, this company met their earnings, they met revised down earnings. So you will officially, most likely, very strong probability of having an earnings recession in the S&P at the end of this quarter. And as a matter of fact, Q2 is also predicted to be recessionary for earnings, meaning lower earnings again. Okay. So you have to understand, even though the people you see on TV and a lot of YouTubers still aren't on board with a recession coming to the USA or different parts of the Western world, even though it's not a question of if for me, it's a question of when and how disastrous will it be. The earnings recession's real. Okay. Even the permeable people who understand the marketplace are admitting, yeah, it looks like we're going to have, weaker earnings again. And that's what the market cares about right now. It doesn't care about a DXY, doesn't care about inflation dropping 1%, which is still way too high. Guys, inflation, that bottom number, to get down to the lower number of 2%, which again is a BS number made up by Ben Bernanke in 2012. But to get that number, people think it's just simple math. Oh, it's just going to go down 1% every month. That's not not how it works. Core inflation actually went up. Inflation is very sticky, which is why we had it stick around so long in the 1970s, losing the whole decade, till Volcker came in and jacked up rates over what did he do? Over 20%, I believe he got to at one point. So you have to understand these things take time to work out, and that's why the Fed is still attacking inflation. But that's not the core driver. The core driver is going to be earnings. And guys, Lee, go ahead and show this chart. The largest amount of puts, right? The largest amount of shorts put on the marketplace ever in the last 10 years, going back all the way to 2011, 2012, by hedge funds the day before the CPI. That means they think the S&P is going to tank. They broke a record going back a decade. Okay, does that mean that I'm right and it's going to tank? No, but I just found out as an interesting confluence point that they think the market's going to tank. Guys, the other thing you have to think about is valuations in the marketplace on historical trends. I'm going to bring in our friend Eric Johnston from Cantor Fitzgerald to give you some numbers on that as well. But just so you understand, the S&P, because again, my thesis, and I believe this will be correct, is if when the S&P rolls, obviously the NASDAQ rolls, the Russell rolls, everything rolls down, which means it pulls down crypto with it, okay? That's why we focus so much on the S&P, the largest market cap, 35 plus trillion dollars. And the S&P has a historical average of where it trades in a recession, and that is around a 12 PE. That is a normal recession. You're trading at an 18 PE. Understand it's a 33% contraction from where you're at. So the market is heavily overvalued, which is why you're seeing all the major banks come out now and say, well, our top was actually like 41, 4,200. So all the risk is to the downside. And now they're coming out their targets of 3,500 to 3,000. And if you understand historical trends and understand the economic indicators, the leading economic indicators, a yield curve inversion, that whole litany that we've been over many, many times, inflation above 5%, you are all but guaranteed, as a matter of fact, going back to World War II, a 100% certainty you're getting a recession. The smart money, the big money, understands this. This is why you saw a muted reaction on a substantially lower CPI, because I think you're going to see this downturn take effect. Again, at this stage in the cycle, they're not focusing on is the relative strength of the dollar 103 or 104, okay? Does it have an influence? Of course it does. But where you are now is coming down to, is this company at this multiple worth this amount of money? Is Apple worth a 26 multiple if their earnings are coming down? Is Nvidia worth above 100 PE if their earnings start coming down? Because that is crazy euphoria. Same with Tesla, same with these other things that you're seeing, okay? So Eric, take it away. Explain what you see in the markets. Do you think this is a great value here of the S&P?
So at these levels, we're incredibly bearish. We think that, our base case is that we go to the low, 3,000s, and importantly, our best case is that we go approximately sideways from where we are now, which would be, big underperformance versus money market funds as an example. The bottom line is that, we think the economy is going to slow down from here. We think it'll slow down significantly, but for stock prices to go down, it just needs to even just slow moderately from where we are today. Our view has been that the economy is going to be weak throughout this year, and it's based on a whole bunch of factors. A lot that we already know: the yield curve, leading economic indicators, and so many ISM and so many other factors. But I think what's important is that it's being pulled forward. And there are real-time indicators that we're seeing right now that suggest that this slowdown is coming very soon.
So Eric,
just to point out, sure.
Yeah, go ahead.
Just to point out a few of them very quickly is, we had the H8 data that came out on Friday. It showed the biggest 2-week drop in loans in the history of the data. If you look at job openings, which are still very high, they had one of the largest 2-month declines that we've seen. And we know that credit standards are tightening quickly as we speak. Well,
so your base case is down about 20% from here. So I'd love to hear your bear case, first of all. But then it seems like for that base case to happen, Apple and Microsoft on the S&P have to fall apart. So what triggers that?
So I think it's important to know where we are from a starting point from a valuation perspective, because this definitely applies to, Apple at 26 times earnings and Microsoft at 31 times earnings, both of which the earnings are probably not correct and need to go lower. But right now, the overall capitalization of the equity market relative to nominal GDP is at the same level as the year 2000 peak bubble. Okay. On a price to sales basis, we are at the year 2000 peak. And then you look at the PE multiple on its own right now at 18.3 times earnings. That's in the 90th percentile looking back the last 30, 40 years. So the starting point is not what you would typically see when you have all these concerns that are out there. So for example, at 18.3 times earnings, if we take that multiple to 15, right, which is a very reasonable multiple in history, we've already gotten the 20% that I was, that I was speaking about. So it's not heroic to get to numbers in the low 3000s. It seems that way based on where things are now, but it's not.
Yep. So that's Eric Johnston, Cantor Fitzgerald. Guys, I love him. I love his hair. I'm very jealous of his hair. But he's absolutely right. He's super bearish on equities here because the historic risk premium. This is what we were just talking about. The risk premium is too high. The risk is to the downside. Could there be more upside? In my view, yeah, sure. Why not? Could you get an extra 50 points, 100 points? Of course you could before a big dump. But the bigger risk is to the downside because of historical norms and historical trends. And a lot of people aren't going to tell you that. They're not going to tell you that on TV. They're going to tell you, oh, well, what I like to do is I'm a stock picker. I'm a stock picker, Bob. I like to find like the good companies that have good value. When the markets roll, everything comes down. Okay. So what we're doing is trying to track with patterns when this could happen and take effective, high probability trades. So let's go ahead and jump into this. All right, guys. So looking at our pattern here again, spent a lot of time on this. I'm not going to spend too much time, but the pivot date's coming up, so we got to talk about it. .com on the left, this is the E-mini on the weekly, and the modern market on the right. Exact same rally pattern up, 9 bars, 63 days, 16 bars, 112. Exact same in the modern market. And the key thing here is the bars between tops. If this plays out, which happens to be on our pivot here on the weekly, 10 bars, 70 days, 10 bars, 70 days, setting up this beautiful double top that you had here in .com. You can see it right here before a 34% drop, and that you have here. And I think this will be our 20 to 25% drop that we get. And this will be the exact same pattern if this continues to play out this way. And nobody's talking about it, but you guys got it here at Market Makers. I'm looking out for you guys. So what does this mean on the daily? Well, as you guys know, for targets, we got a lot of people in S&P shorts. Gave you this short over here based on the pivot pattern as well. 9% drop. I told you 41.43 to 41.80 continues to be our line of resistance. A lot of people scalped here, got this nice little drop, like 90, 100 point drop. And now on this CPI pump, we got back up to 41.50. Many of us re-entered trades. Of course, I had this trade posted on our Discord, guys. Again, you can come check out our Discord for free. Try out one of our sponsors on the daily time frame, looking for this pivot date here, and then I'm looking for selling. Okay, that's what we're looking at here. And again, why do the pivots matter if you're brand new to this channel? Because the pivots matter, guys, because going all the way back to June of last year, these pivots have captured key inflection points in the market, such as the exact bottom, the exact top, the exact bottom, the exact top, and within 20 or 15, $20 of the exact top before that 9% drop. And of course, we have this move incoming, guys. I do believe if the earnings are bad, if the guidance is scary or bad or murky from the banks, that's going to be your catalyst you need to start declining. And the key thing to understand and the pattern of decay that we are in is so far, it's repeating the exact same pattern of decay last year. And I noticed I was watching a show with one of my co-workers in the room yesterday, and they're talking about my pattern without realizing they're talking about my pattern, these two traders. And one of them says, did you notice that like the swings in the market so far, how they're forming this year, kind of match what happened last year? been saying this for over a month, guys. This is the pattern that we have, okay? So last year, we had our downfall in late March, early April. That entered our pivot pattern, okay? That's where we are now. We're here at mid-April. You have your sell-off. You make your bottom in June. That's the leg that we're going to now. Selling off here at our pivot. The selling can start next week. And that selling, of course, there'll be waves up and down, guys. But that selling would continue to our next June bottom. You make that June bottom, and then you come up to your August top, just like you did last year. Your August top sells off and gives you your October bottom. This is the 6-month rally that we are on now. And that's why I said you will have two bottoms. You'll have a June bottom and you will have an October bottom. And if the pivot pattern continues to play out, those dates specifically would be June 14th. So you could say mid-June, August 14th for the top, and then October 12th would be your final bottom in the marketplace. Does it have to play out this way? I see some people I respect, some economists such as Jeremy Grantham, saying he thinks this can play out into 2024. Yeah, it could play out into 2024, but I'm basing this off the 7-year cycle and what we saw in .com, what we saw in the great financial crisis. And if you guys understand the 7-year cycle, I actually uploaded Jonathan Kahn's video on our Rumble. You can go to our Rumble and watch it, the Shemitah cycle. Many people on YouTube pretend to understand what it means. They don't actually understand how it works, guys. It's very key to understand how it works. In the market and .com, you have the Shemitah cycle, the 7-year cycle begins in September. Okay, it's according to the Hebrew calendar, begins in September. September of 2000 to September of 2001 was that year of the Shemitah, the 7-year cycle. The bottom happened October 2002. Okay, so you have to understand when it starts and when the bottom. So you have that year of decay, and then you had more downfall after the Shemitah ended, and then you made your final bottom the year after. It's the same thing in the great financial crisis. September of 2007 to September of 2008, that's the Shemitah year. Okay, you have a lot of decay in that year, but what happened? The market dropped even more until you made your bottom the following year in 2009. And this market cycle, September 2021, is when the Shemitah began. It ended September of 2022, and the market should bottom here if we continue this cycle that we've been on in October of 2023, just after the fall equinox. Okay, so that's the 7-year cycle. You don't have to believe in it. I don't really care. You can do a simple algorithmic study and see how much money you would have made if you had invested along the 7-year cycle going all the way back. Okay, if you invest it to say at 1969 or whatever, every 7 years, if you, according to the Hebrew calendar, the Shemitah year, took your money out every 7 years, you would 3.5x somebody that just bought whatever that random year is. Pick the year 1970. Somebody that just bought in 1970, and you were investing along that 7-year cycle, taking your money out for a complete year once every 7 years, you would have 3.5x the person that sat there and held the money. So again, don't care if you believe in this cycle or not. You don't need to leave me your opinion about how stupid it is. The fact of the matter is, I got out of equities in November of 2021. I got my family out of equities, and you could have simply done it on that one simple data point, and you would have missed the 34% drop in the NASDAQ, and you would have missed the 24% drop in the S&P in 2022. And I'm looking for the bottom this year. So that's where we're at in that market cycle, guys. And let's go ahead and look at this as we continue. So this is still key resistance. Can you pump up here? Could you get the 4,200? I mean, look, we got a couple days left to the pivot. This pivot could be your actual high here in trend as well. So yeah, maybe you get above 4,150. These small movements don't concern me. The waves don't concern me. It's where we are going in the trend, and that trend is decay, and that trend is down, I believe. So let's go ahead and look at this on the daily here, zoomed in. And of course, what we're looking at doing, guys, is completing this double top here here on the S&P. Whether we get here, here's our range that I gave you, the 41.43 to 41.73. I've got the 41.50 once again. So this is what we're looking at, is this massive double top, breaking this neckline, and let's see where this would bring us, because you know that first stop is going to be retesting the October lows. Look for strong support there. So let's see if we can measure this with our trend-based fib. And going to my impulse moves here, let's go up to our high. Look where your 1618 lands you, right at the October lows, 35.57. Of course, you're going to have, as price decays, if it does continue to decay here and the earnings cycle and price comes down, you're going to get reflexive bounces, guys. This is just how you move in the marketplace, okay? But I'm looking for that retest, the key retest at the 1618, 35.57. And of course, I do believe you will be losing that, going down to a new low in the marketplace. And again, that number I have 31.41, could be 150 points lower, 150 points higher, doesn't matter. Important thing is got in up here to ride this down. Okay, let's go ahead and look at the 3-day chart again. Where are we going here on the S&P? And that next level, guys, will bring us down to our 31.41, the FOMO phase, when all the big bears on TV think the washout has occurred. Now's the time to buy. And we're going to trade this rally, because this rally I anticipate being a very strong rally. Could easily be yet another 20% move to the upside. And again, if you lose that rally and fail, this is your bubble. Now you're in a bubble, okay? You lose that rally and fail, I think you're in a bubble anyways. But this is a key turning point in the market when you lose that 35% marker on the S&P, because every single bubble has hit minus 50%, which again is the 1618 at 2409. I think you're going deeper by October. I think you'll be at 1888 to 2000 by October. But sweeping that low, that 31.41, wherever this market bottoms on this next leg down, that is key to understanding the pain that is coming in the marketplace. And why is this called disgust? Again, this is my take on Dow theory using Fibonacci waves. It's called disgust because nobody wants anything to do with the market. A key test, just psychologically, to understand if you truly were in a bear market at the bottom or not, is did everybody hate the assets? Trust me, if the S&P comes down to 2000, 1888 to 2000, everybody's going to be, F you stocks. I want nothing to do with you. If Bitcoin comes down to 4 to 8K, there'll be people like me salivating to buy, and there'll be other people that just hate it. It ruined their life. They wasted all their time. They wasted all their money. And guys, just statistically, that's 80% of retail. 80% of retail loses money. And part of that is because they don't understand market cycles and where you're going in the marketplace. Not that the big money understands this, but the big money has what? Big money, okay? They can move the markets. They can make bottoms where they want to, where they all think there's a bottom, such as the FOMO phase. Retail doesn't have that ability to do that. You saw a little bit like Wall Street bets and stuff, trying to force some moves in the market. And, those are small moves in comparison to moving a $35 trillion market cap. So that's where we're at, guys. And again, this is our compression here on the S&P. And you're looking at our red zones. These are the big moves, the 20% moves, the green zones, the 10% moves. Volatility is compressing. Big move is incoming. I do believe that big move is down. The VIX, of course, is close to our historical bottom going back 20 years and bear market. See, in a bull market, you want a low VIX, right? You want a stable VIX. But in a bear market, a low VIX gives you a bear market top. Whereas you can see, you could really zoom this back out here and get your trends going all the way back here. You can see where your VIX got to January 2022. This was your all-time high, January 4th in the S&P. That's your VIX at 16.34. But you can see where you started reacting to, that's even higher. Let me try to find it down here. You're 1745. You can see the different levels of the VIX here. That's why I have this level selected at 18, because going back to .com, that 17, 18 level gives you these spikes in the VIX, and you're just flirting with it, guys. You're flirting with it at 18.80, and you can easily spike up. And of course, I'm looking for the VIX to get above 50 when we actually have some parabolic moves to the downside, below the 50-day moving average. But that's what you want, guys, is you want a low VIX before a big move in a bear market. It's kind of counterintuitive, right? It's counterintuitive. But looking at the DAX, DAX hit our targets beautifully that we've been talking about, guys. This is a 3-day chart. You can see the volume has just been bad here in the 3-day chart as well. Looking at the DAX, you have money flow divergence, lower volume here. Let's look at this on the daily chart. Daily chart, there's a range I gave you, 15,733 to 15,846. The DAX got a nice little CPI pump to 15,855. I do believe this will be topping out as well. You can see the DAX on the daily is moving up to the overbought range, okay? Moving up to overbought, and it tracks very closely with the S&P. I like this trade. I'm in this trade off of this pump as well. So that's the DAX, guys. And that's, what is it at now? 15,789. Looking at Bitcoin, our wave pattern. Bitcoin hit a nice higher up target that we were talking about here on our daily time frame, guys. So Bitcoin got up to our 30,398. That's a 786. Upside risk to me, if Bitcoin does want to make a breakout move to the upside, is up here at 31,463. One of our traders shorted it right here at this level, and you're just stacking candles left and right here. And I do believe, guys, and I know a lot of people don't believe this in the crypto space. Talking about some of the biggest names, they're showing you million Bitcoin, 100K Bitcoin incoming, the all-time high incoming. Guys, Bitcoin is going to track to tech in my belief. Okay, why? Because it's done it since its whole inception. When I first came to crypto, everybody said, hey, Bitcoin, this is back in like spring of 21. Bitcoin is the ultimate inflation hedge, right? That's what they were saying. You have the little articles popping up. Bitcoin's the ultimate inflation hedge, and we're just printing money. We had the pandemic, so it's an ultimate inflation hedge. And then what happened when we had peak inflation? Bitcoin tanked with the markets. Bitcoin went down 75+%, while the NASDAQ went down 34%, basically moving at a 2 plus beta to the NASDAQ, okay? Bitcoin's been on a tear up, so has the NASDAQ. When did they both bottom, guys? They both bottomed back in October. Bitcoin here in November, but I think this other bottom here was in June. There's your June bottom. And so that was your rally. So they're moving extremely close overall trend together, okay? You got to understand that. So when I think the NASDAQ rolls down, Bitcoin's rolling down too. And yes, I do think it's sweeping its lows when the equities sweep their lows. 8-hour chart, you get a little bit more information here. You can see we vibrated here in our Wyckoff trading range, got a nice pump up, hit our 30,400, and now you're just stacking candles here. Looking at the 8-hour, you got overbought here on the MFI. But, again, with the earnings coming up, we got to see what Bitcoin does. Upside risk to that 31,463, and the 8-hour you could start printing a shape, a double top or whatnot. But we still have Thursday and Friday until we have those earnings were coming out Friday. So it'll be interesting to see how the market reacts, because judging by the sheer amount of shorts in the S&P, again breaking a 10-year record, they are holding on for bad earnings season and a market decline. The NASDAQ still respecting our 13.1 target, guys, that I gave you. As you can see, we have 13.1 on the NASDAQ. We hit it again today on the CPI pump, trading at 12,990. And this seems to be a strong level of resistance. Upside risk to 13,455, meaning you could see some wicks up here in between. And those to me are just trading opportunities to short to the downside, okay? Lots of people in here on that 13.2, 13,150 range. And let's see what this does. But again, I have the NASDAQ coming down to sweep its low as well. And that low, by the way, was what? 10,417, 420. I have the NASDAQ. You can see here if the various ways, I got my 1618. 9,100, 9,200. That's where I have the NASDAQ coming down on this next wave down. Could it come up higher? Sure. But I think it's sweeping its low. That's the key element in this, okay? When you're looking at individual equities, looking at Bitcoin, looking at the indices, where do I think they're going for that June bottom, as that mid-June bottom as we continue to decline? If the market breaks the way I think it will with the pattern, you're sweeping your lows that you put in October. That's the key concept. Definitely will get a nice potential bounce off the low, but losing the low, coming down to that mid-June bottom is what is a key concept in my TA, guys. That's what I'm seeing in the marketplace. NASDAQ on the daily. Again, a little bit zoomed in level here on your fibs. You can see this. To be more specific, we got to that 13,198 on our first short, came down. A lot of people are probably still in that and try to get back up there. And a lot of people entered here on this second entry, guys. But that's just the NASDAQ. And looking at the money flow, there's your peak. And money flow is showing you went to the bearish trend here. The volume got overbought. So again, the markets are kind of on pause. They didn't care much about the CPI, and they're on pause, waiting to see what earnings are going to do. And I think that's going to be potentially pretty bloody for you Larry David fans. Tesla guys gave you that short entry at 208, and we got all the way down. By the way, how low did we get here on Tesla? We got to 176. So that was lovely. 208 down to 176. Nice, lovely trade. I think a lot of people are probably still holding this. Why? Because you printed a massive double top. I have Tesla sweeping its low at 101, which means you can come somewhere between 70, 75, $80 on Tesla. And I guess if things got horrible, you could go below that. Okay. But again, Tesla historically does this in its decline, makes these double tops, and you get a broad wave of selling when it does this. Okay. So looking to sweep that low. Again, key concept, another successful trade. First Solar gave you guys a 217 entry. We got all the way down to sub 200 at 199. I'm assuming a lot of people exited this trade on the pump, keeping those profits intact. But you can see you're back up at 212, 213. I wouldn't do anything here unless you got back above that 217 range if you're looking to enter for the first time. The pattern here, you're just mid-range and Wyckoff. You can easily come up for an up thrust. You could just roll back over, but I would wait to see if you get any higher here on First Solar before re-entering a trade. Looking at MSTR. Oh, this was the alternative that I posted for Bitcoin short in the room. I posted this as well today. So MicroStrategies, Michael Saylor, okay? Looking at the MFI, you have bearish divergence on your MFI. This moves heavily, obviously, with Bitcoin, okay? Tracks very closely to Bitcoin. But you can see we're at this key resistance range, the 618 here at 333. I like this as a potential entry or slightly higher. Obviously, if Bitcoin's pumping, you'll see this move up as well. And I like my stop somewhere around just above 360. On the daily time frame, I think the ATR says this is about a $20 move per ATR. I usually like to use a 2 to 3x ATR when I trade, but because of the type of trade this is, I would just be happy with putting something up here above 360. And, again, that entry I'm looking at is 333 or above. You're at 328. You can also sit on this a day or two and see if this moves at all, right? Because if Bitcoin doesn't have any more upside to it, you could see this get a better entry. But I like this as an entry between 333 and 360, matching this quadrant. And where's MicroStrategy going? I think you're coming down to 102. Okay. When this thing tops out, I think it's coming down to 102. Just give you an idea, guys. It's 330 right now, $330 right now. I think you're coming down to 102. And that's just on the next wave down. Okay. Because again, what's the key concept? Sweeping your low. Okay. Sweeping your low that you put in. So I think you're coming down to 102. That's the next logical stop for me. Looking at gold, guys. Gold here. 3-day chart again. Gold is really struggling at our well laid out fib, if I must say, if I can pat myself on the back. This fib has been awesome. Okay. So we had the rejections that we had at 200. We're getting our rejections at a 223 range. Of course, the 1618 at 2055. Again, I watched Peter Schiff's podcast because I enjoy his commentary on the marketplace. I know he hates crypto and he's super gold bull, but he keeps saying below 2000 is a great buying opportunity for gold. Guys, I just think it's risky. I think there's so many other things you can trade that don't have this binary nature to them because you're so close to that 2-year historical high on gold, whatever that high was, 2080 or something. Every time you got up here, and again, look at the volume difference that was required on this wave. It's a 3 sigma candle with a lot of follow-up bars to keep you in this upper quadrant versus the volume here. So again, if this wasn't gold, if I took gold off here and I was looking at the volume, and let me look at the money flow and everything, and I was looking at the money flow, seeing that when you get overbought on your 3-day chart and this huge volume bar, and then you sell off 20%, 20+%, I would expect the same thing coming up here in the overbought territory in the money flow. I'm still expecting that big move down. You're really struggling here, and you don't have the buyers when you look at what it took to get up here. And all you could do is try to hold it before you capitulate it. You don't have the buyers. The other interesting thing is, guys, I want to show you this because people talk about, why do you buy gold? I own physical gold. Okay. So I'm not trashing gold. I own physical gold. I own physical metals. But Why do you buy this? It's a fear trade. It's a fear trade for inflation. It's a fear trade for, economic disaster, but it's that but it's also moving with the S&P. Okay? So this is the S&P on gold overlaid, okay? Not candle for candle, but I mean there's your dips, that's from your pandemic. You see your S&P pandemic. This is your S&P in gold. That's your S&P. Here's your dip. Let me turn this to a line chart. Maybe you can see this better. There you go. So gold's in blue. I know that's confusing. The S&P's in orange. All right, but you can see your peaks here. But the key thing is you don't have to try to line this up. Look at your October bottoms. October bottom in the S&P moves up. That's the orange line. Blue bottom in October on gold moves up. Look at the dip. The dip is the same. It's tracking to the equities, guys. So again, is it lockstep? No. But I think the market cycle will repeat itself. And by that, I mean the GFC market cycle where commodities reset as well. I think gold will come down. And guys, the more I look at it, the more I think it's coming down to 1389. I know that's upsetting, but it's not really for me. I view it as a buying opportunity. Would I like my gold to keep appreciating? Yes. But 2055 is a key level, and you got to flip it and hold it when the markets roll. And the way this thing's setting up, the way that it's so closely tracking to the equities, makes me think it's going to roll down with the equities. Okay. So that's what I'm looking at. With gold, my view has not changed. So just be aware of that. And of course, sweeping that low would be sweeping 1626. So that's when you're going to know if I'm right or not, is when gold retraces from 2007, or I guess if it comes up here to 2055, you'll be hitting most likely overbought on your MFI like you did there, and then looking for that 20% move. And you really need to hold 1626 because that's your low. And if you don't hold it, I think you're coming to a lower target of 1521 or 1389. Historical trend, GFC, you went down 34%. 1389 is a huge move, but it's only 32%. And I think that could happen, guys. So just be aware of that. But what's after that? Parabolic rise in gold, because I don't think the Fed will extinguish inflation. And I think it's a great buying opportunity. Looking at where we just did gold. So let's look at silver. Silver, same thing, guys. Silver, I mean, this is a trade that I shared with you here on this channel. The 2441 entry gave you a 20% down move, and that was being overbought on the MFI. And look at your volume. Your volume was actually better on this one, right? So your volume was better. You're still bearish here on volume. You got the silver uprising, more parabolic. You tap the 2547. I told you could hit that, the 786 fib, and you're not quite overbought yet. You see that? Really want silver to get overbought like this to get these nice moves down, these nice 20% swings. And guys, on the MFI on silver on a 3-day chart, this is a Market Makers MFI. You get this for free when you join our room, by the way. You get all of our indicators for free. We don't sell you indicator packages. You look at these every single time in the overbought range. Look at these drops you get in silver. You see this? You get these nice drops in silver. So I would wait until this gets overbought, which could be closer to that 1 fib at 26.99. And actually, let's throw on that 886 fib because that's in between here. And that might give us a nice target as well. Where are you? Blue. There you go. That would be, can't see the price, 25.18. That didn't work. Hold on. This is messing with my OCD. There you go. 26.18. So watch the 786 where you're at now and the 26.18. And of course, the 1 fib at 26.99. And guys, I know it sounds crazy, but like I said, the metals could hold up here. I don't think they will because of how they track to the equities. But just consider that. Understand, look at what the market's doing before you take any type of trade on metals, right? So the upside for me is limited from here until you see the metals pull back with the market falling and they hold this base, okay? But keep that in mind. I'm not saying I would run out and short this either because it goes against everything that I stand for in the marketplace, but you cannot ignore the technicals and the opportunities to make money. So watch for these overbought signals. Gold, key area 2055, and again, silver, watch where it's at now, 25.31 up to 26.992. If you get overbought and you have low volume and you see the equities starting to roll and the metals start rolling, it is an opportunity to trade because again, that silver target is much lower as well. Let me go ahead and give you that really quickly. We'll just use a trend-based fib. We'll just do a wave projection down here. I don't remember what my geometric pattern had, but that would be silver at its low at 18 here. I think I had 16 for the target, if I believe so correctly, for my pattern target. This 18 is just retesting your lows. And again, that premise, losing your lows, watch for silver to move down. And that's a big move, guys, when it's trading above 25. All right, long video. Hope you guys enjoy it. I'll respond to your comments. Come hang out with us in our room. And another video coming soon, guys. Watch the markets. I'll put a video out either Sunday, like a kickoff show again, or, whatever, Monday. We'll see how it goes. Lots going on in the marketplace, guys. Take care, everybody. Have a fantastic weekend.